All right. Hello, everybody. Welcome back to another Maddox Market Musings. Thanks for joining us this evening. Roy and I are happy to share our thoughts with you all, this evening, and we'll just talk about the choppy market we've seen. It's obvious if you've been trading these past really 5 months, how difficult it's been. And that just has continued. If anything, it's gotten a little bit worse, I think, in the last 30 days or so. So, we're gonna talk about some things that have developed in the market. We'll talk about I've got a list of positives and negatives, because I want to sit here and be balanced. In the view, I want to be flexible. We want to be able to stay out of the market if it continues to chop around like this, but we also want to be prepared for the market to go against our expectations. We basically don't have any expectation at this point. All we can do is sort of react. And I'm going to go through a good list of the positives and negatives that kind of give you a sense of the market. It appears like it's going to break one way or another, right? But that's the issue. It has not been a very decisive market. We've continuously bought up really weak opens, and you've been penalized for chasing things up over and over again. So anyways, with that, we'll go into a lot of what we're seeing, and hopefully this can, be informative for you guys to, help you navigate what is particularly a difficult market. And most importantly, right now, there shouldn't be a lot of pressure to do a whole lot. You can see if you're chasing things up as Trump is tweeting or oil is going up and down. You're not going to miss it. If we're going to have a sustained uptrend, we're going to have the Nasdaq going to all-time highs. We're going to have a number of stocks setting up. And if we go to all-time highs in 4 days and you're uninvested entirely, just know that those 4 days don't really, that's not where you make all your money. You're definitely, if you're staying engaged and you're in tune with the leaders, you're going to make a lot more money in those 3 to 6 months following this, kind of nasty consolidation. So, we're gonna, we just want to encourage everyone, right, to stay engaged and, play small, because it's just not that important to be the first one in the pool here. So, with that, we'll get moving on with the presentation. So what we're about. This is, if it's your first time here, we have retitled the Maddox Market Musings. This is Roy and I's meetup group that we have been hosting for, I don't know, at least 5 years now. A lot of what we go over is grounded in the How to Make Money in Stocks book by William O'Neill, and a lot of the resources we're using are Investors Business Daily resources, and they've been instrumental for Roy's career, and of course they've been instrumental for me. And some of the concepts like can slim, we'll go into a little bit of detail, but please use these resources. We find them very helpful, and we think they'd be valuable for you as well. As a disclaimer, these are just discussions. We're giving our view, but it's definitely not a recommendation. Please consult a financial advisor, your financial advisor, for buy and sell recommendations. We're just going to give our opinions, though, and do our best to educate, how we see things. And for a little background, this can slim, which I just mentioned a couple slides ago, this is just a real high level view of fundamentals of things that we're looking for in stocks. This is something that was coined by William O'Neill many decades ago. And we find that it's valuable today still. This sums up a lot of what we're looking for in these individual names. And, a lot of this, it's kind of, it does become an art more than a science, but these are all, key ideas for, what we're looking for and what we're going to find in the big winners in the market. So study this, review this. It's in his book. And it'll be valuable for you to understand these 7 criteria. So we always go over our sort of 3-pillar process, and we talk about technical analysis, fundamental analysis, and macroeconomic analysis. By the way, Roy, are you getting any feedback? I just have this from Jay. He's saying he's got feedback on his speakers. Do you have any on your side?
I do not. No.
Okay. Sounds good. So anyways, these are the three pillars. We kind of lead with technicals. We find that's the most important, right? It doesn't matter our opinion about the fundamentals because these technicals, price action will top far before the fundamentals peak. Stocks will bottom long before the fundamentals bottom. So, most importantly, we just want to be in tune with the trend. But fundamentals, of course, very important as well. And that's where I have like a deeper background as an analyst. And I think, a lot of times what's nice is during these corrections, it does help you to do a little bit more fundamental research, especially in bear markets. You can do some fundamental research, right? Look for your ideas, and you sort of wait for technicals to confirm your view. And the last thing we look at is macroeconomic analysis. It helps to kind of guide us from a very high level. It doesn't. We don't lean on it to make. It's not the number one thing. Obviously, it's third in our list for a reason. But nonetheless, we like to be informed. We like to understand the framework we're of the economy that we're in. We kind of just look at that from a high level growth and inflation, and then with that, the Fed. Everyone knows how important the Fed has become in the investment landscape. So those are really the three things that we're just trying to kind of key in on for macro. And for technical analysis, this is a good list of the indicators that we're looking at. Primarily, we're going to focus on price, right? Because we're trend followers. We just want to be on the right side of the trend and get 80% of the move. The trouble that we've had, recently is there hasn't been a very clear trend, right? I mean, if you've been actively trading it, that's very, very clear. There is no trend, right? The market cannot decide which way it wants to go. So that's particularly tricky in some of this. And so what we've been forced to do is we'll trade a little bit lighter, take losses, and kind of take paper cuts over and over and over again for 5 months. And it's it does add up. It's painful, but it can be discouraging. But certainly, Roy and I are not going to be discouraged, and we've done this enough. We've done this many times where we're going to be here when the trend changes, and certainly move the needle in our accounts when that happens. So we're very, very engaged here. I'm trying to figure out where these leaders are going to be, and but the market has been tricky. We'll go over some breadth and sentiment things, by the way. That's going to be in our presentation. I want to go over some of those because there are some positives showing up there. There are also some potential negatives showing up there in all these technical indicators. So I think it'll be a good overview of really what I look at regularly, on a daily and weekly basis, and kind of where the conclusion that I'm coming to today. With the caveat, like I can, we can always change our mind and pivot, and that can happen on a dime. Certainly, things are very dynamic. We have Iran and oil prices are driving the market entirely. It seems like, and there's always an AI headline or something or another that can, that's really moving the market quite a bit recently. So it's been very headline driven as well the last few months. Fundamentals, I went over that CAN-SLIM acronym. That is a good starting point for fundamental analysis. You can always look at balance sheets and income statements and things like that, and cash flow statements. But this is a high level, and we find that the market surge program boils down a lot of those indicators for us fundamentally that are very helpful. So it's definitely one important tool for us, and the fundamentals, feel free to get as deep in the weeds as you want, but there's always someone out there that's doing a lot of work and uncovering some of these gems. But anyways, this is a high level approach for us where we can do scans and find the things through this market search program to look for things like the 25% annual earnings growth and accelerating revenue growth and ROE and things like that. So again, fundamentals, another key pillar for us. For macro, we do keep it high level. We subscribe to Hedge Eye Research. They're a great shop for macro research. And they do, it's all data driven, numbers based. And, we just kind of want to understand where we might be from an economic perspective, and what we might expect to be strong sectors and weak sectors given the regime we're in. Of course, things change all the time, and recently, for example, right, the big spike in oil has brought the economic projections for the next 2 quarters into this quad 3 area. So that's growth slowing as inflation accelerates. So basically, it's a very, very logical transition now where we've got this issue, right? This problem of elevated oil prices, which will feed through to inflation, which is never good. And of course, that doesn't happen in a vacuum. The cost of oil, as that flows through, of course, that's a negative to consumption in a bunch of other areas as well. So that's a very recent development, but nonetheless, it does change. Now you've got to react. So what the market is presenting, and that happened very quickly. And as an example, one of the things that we saw setting up really strongly was like we're small caps and mid caps. Maybe just 4 or 5 days ago, were setting up what looked like really strong VCPs, and then oil spikes, and all of a sudden, small caps and mid caps are getting crushed, and the large cap tech names are actually much stronger relative to those, when we had just been seeing the opposite for 2 months. So you just have to react. That's just what it is, part of it. And all that could change by a week from now if oil prices plummet because we put a new regime in Iran. But there's going to be a lot of narratives and a lot of noise with that. So we'll talk a little bit more about that too, about how to sift through a lot of that noise, because there's going to be a lot of it. There's a lot of different people in the cabinet talking and different things like that. So we'll go through what I think might be helpful for you guys in that regard. Okay, and so I've been showing this chart now over and over again for several months, just highlighting some of these key events, right? Key news items and things like that. The last 6 months, we can talk about some things. This, I find it fascinating, a lot of this, how things react. Right here, the whole 2025 could be defined by the tariff and trade negotiations, right? That's what the entire narrative for the entire year was. And then right here, Trump confirms that a China trade deal was reached, and then that's exactly when the market started getting worse and more difficult. So man, what a lesson in market dynamics that is, of selling the news, and understanding that the market is discounting this the entire way up, knowing that we're going to find some kind of deal, right? Unbelievable stuff. There's this noise of the government shutdown. Okay, a good rally, Nvidia earnings, which to me, at the time, I thought, man, the market was about to get its butt kicked, and then, despite what I thought, it continued to just rally in my face and back above the 50-day. We've chopped around over and over again. Kevin Warsh was announced to be the new Fed chair, and that's when silver and gold had their flash crashes. Those overnight crashes where I think silver was down like 40% in a day. And then this day, notice it's actually the blue day, is that Monday after we struck Iran. So we, of course, we gapped down. Futures were down overnight on Sunday, and then we actually closed. Really strong that day, and that was an easy day for me personally to be sucked in. Right when you think about, wow, buying up that negative news, just to be completely reversed that next day, and then close at the highs. So that's the kind of crazy, frustrating market you're seeing, where you might think, man, we just bought the negative news, we're going to follow through, but no, the very next day you open at the lows and you think, oh man, I got bamboozled. And then if you sell the open, which you might be keen to do, because that's what a nasty, completely reversal. That's what Roy calls the Kaiser Soze day. And then we go on to rally in your face. So all of a sudden, if you sold the open, maybe you honored your stops, right? That was one of the things we were talking about, right? If you honor your stops, or do you pull your stops, right? Do you pull your stops at the open? And that was a tough, that's a tough call when you're gapping down like that. And the question is, right? Are you gonna honor your stops every time, or only sometimes? And then the one time you don't honor your stops, are you gonna get really penalized? So that's a frustrating day, but we did honor the stops that we put in place Friday. So it is what it is. That's the difficult market we've been in. And then here we are again with another choppy Monday where we gapped down quite a bit. Things looked pretty bad. Sunday night, oil was spiking. And then we reversed and closed really, really strong. We were up 1%, I think, at the highest today almost, and ended up closing negative. So, lots of different things going on, lots of tough stuff, but we'll go through again how I'm seeing things. I know this is just headlines and we're kind of recapping what we've seen, but we'll go through like indicators actually that we're talking about. And then this FFTY, by the way, just what we always talk about for CAN-SLIM investing. How are these stocks doing? These are the algorithmically updated leading IBD 50 stocks. It's choppy. That's all, right? It is. And a couple of times it looked like things were improving, and and then you get these nasty corrections. And a lot of what these leading stocks were in, for example, this was probably gold and silver miners. And then you get like a 15%, 20% correction in 4 days. And then, a lot of these, I don't know, those would have been maybe some more gold and oil, silver stocks again, even. But, the choppiness is tough. And this is back in October, November. You can still see kind of like where that trade deal was reached in October. That's where you got a negative character change in that FFTY in October. All right, so what I'm going to go through is the positives, okay? Because no doubt there are some positives, and it's just trying to figure out. I'm just trying to stay balanced, right? I just want to stay balanced because I don't want to sit here and get bearish and say, man, the Iran war is never going to end. We're going to be there for a decade. Oil's going to be at $120 a barrel for the next 3 years, and the AI trade is over and it's all bubble. Right, so I'm trying to be objective here, and we're gonna go through a lot of positives and a lot of negatives, and kind of see where we shake out. And I hope it's useful, just because again I really want to be. The fact is the market is kind of holding up pretty good despite a lot of these issues that are evident. But let's just go through a lot of these things that are telling us reason to be positive here on the market. Okay, for one, we've got this huge, massive spike in oil prices. Okay, they hit $120 a barrel. I guess it was Sunday night, or it could have been Monday morning even. But it's very likely that the high is in. Right, you don't get a spike like that. That's a very consequential spike. Volatility in oil was something at like 90 or 100, which is massive. And the break in that, it came down, 30% in a day or two. That tells us something, right? And that kind of we think that's probably put a little bit of a bid under the market. The fact that oil did top, and you can see that inverse relationship with stocks in real time. If you've been sitting in front of your computer, your monitor for the last 48 hours, you can certainly see that when oil spikes, the Qs come in, and when oil comes down, the Qs rally. So that's been a very dominant factor right now. And for me, it's kind of the number one thing to watch, right? To say, hey, how are things going in Iran? Is it escalating? How long are we going to be there? This kind of is trying to put all of that information into one price. And there's a lot of noise and a lot of tweets that are, some are being backtracked and some may not be true. So, anyways, that's positive. It's very, very likely that oil peaked based on that action. Another thing we've talked about in the past is this is the futures positioning data. This is from the commitment of traders report. What you have is these blue and yellow bars. These are the speculators. And so when you get really crowded to one side, these were crowded along the NASDAQ. This is the NASDAQ positioning. Speculators were very, very crowded along the NASDAQ in October. This was the October high, and this was actually like November around Thanksgiving. With that, it has been difficult for the market to rally, right? Over the last several months, the net long positioning for speculators has come down almost to zero. So we are extremely neutral in that. Now that doesn't give you a huge edge in either direction, but what it does tell you, at least, we might be more than halfway there to getting a better risk reward, I guess, for the NASDAQ to rally. Sure, can these speculators get net short? Of course they can, and they have, right? You can see, in January, early January 2023, when the market was bottoming, and really, the bull market sort of started early 2023. People were net short, and these commercials were long. The smart money, I guess, or the institutions were net long. So we have a little bit of room here to go, perhaps, right? If we're going to have a nastier correction, I'm sure that people are going to start piling into shorts late, and get more net short. So, anyways, this is definitely a positive. It's considering how crowded we were. This is a monstrously crowded NASDAQ positioning point right here. We have worked through that, and that is that definitely tells us some important information. This is the NAAIM, the National Association for Active Investment Managers. You can see this peaked in that 100 range, right, which we've talked about many times. When it hits 100, it becomes a meaningful risk signal. We did have that hit 102, I think, in that October high too. And since then, it's been working its way down. Okay, so again, kind of neutral, but the risk reward is improving, right? Just like that other positioning data showed, this is going from 100 to 80, is an improvement, right? We can see that meaningful lows might happen closer to 30. This was a November 2023 low. That's close to 30. Back in the tariff lows, this hit like 38 or 40. And then at the bear market lows of 2022, this was like 15. So it's extremely washed out. So there could be more room to go, just like the speculators could go net short in a meaningful way. This could still go lower, but the risk reward is, we're watching it improve. It's something that we monitor. It's something that we think you should monitor as well. This is a great source. It's free. You can just Google NAAIM, or you can use stock charts like we do to use this. But it's updated every Thursday with that data for how long active investment managers are. This is also another free index. This is the Fear and Greed Index from CNN. This in that fear, it's in that fear gauge. Again, improve. That's a positive. Certainly, sentiment is improving. Improving meaning getting more negative, right? So telling us maybe we're closer to a low. That fear, of course, we can get to extreme fear. We've been to extreme fear. You can see a year ago, right? A year ago we were at 17. So a year ago would have been, right in the thick of the tariff bear market just a year ago. So that can get very low. Obviously, we can get there if things unwind a little bit more. And here's a line chart showing us, the history of that, of this indicator, right? So back here again, this is April 2025. So we would have been right around here in March and bottomed in that really low, low single digit fear and greed index. So again, improving, right? We were up here at what, 60, 70 the start of the year, and we've clearly come in as people have gotten frustrated. This put call ratio, again, same thing, neutral, right? It's sitting here close to 1. We see these spikes that we marked where they were, they marked some pretty significant lows in the past. where we were living above that 1.15 level for the put call ratio. That is, it's inching up, right? It's not complacent. We did have complacency back here in November where we were below that 0.8 level. And since then, we've gyrated, whatever. Not a spike. This is what we look for to spike. Just like the VIX, we might look for to spike. This is not spike, but it's getting us in a more balanced situation, which is good. The AAII bull bear sentiment surveys. Bulls we hit like 50% right there in January. Since then, we've come into 33%. When bears get north of 50%, that's usually a nice sign of a good low. We hit actually 60% bears. Maybe even 60 might be like the really good, extreme that you want to look for. 60 right here, really, really close to the low of the 2022 bear market. And then same thing right here, that, north of 60, really, really close to that low for the 2025 bear market. So, yeah, something to continue to gauge. Not a great, again, no signal here, but something to keep an eye on. Would love to see that pick up as well. Okay, and another positive I wanted to call out from this chart. This is just a look at the Qs. You kind of have to squint, I guess, to see the positive here. But the point is, we have had a lot of good closes, a lot of strong closes, where we're closing, near the highs of the day. A lot of these, bam, 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 and one of the stats, I didn't double check the stat to be honest, but it says 14 out of 17 of the last 17 days we've closed higher than we've opened, which I thought was interesting. So that means that, and it means exactly what it says. But you would not expect this choppy of an environment. If you heard that stat, you would expect, oh man, we must be having a great, strong bull market run. We must be up at least 5% in the indexes if we're closing higher than we opened for 14 out of 17 days. Wow. Not the case, obviously. We've just had this nasty, nasty chop. So, it's slightly positive. Typically, that would be characteristic of a positive environment, that we continue to get bought up at these, gaps down. But also, when you look at what's happened in the last 6 weeks, and this is just, untradeable, right? You can trade things for undercuts and rallies. I guess that's really what you need to be, undercutting yesterday's low and buying panic, and then, getting the rally, but you can't really hold on to anything for more than a couple of days. That's for sure. So, that's kind of what you can see there too, just the choppiness. We did hit oversold readings on the McClellan oscillator. This is the New York Stock Exchange McClellan oscillator. So, it does have a nice diverse basket of stocks. I typically will look at these NASDAQ McClellan oscillators more, which didn't even actually hit the oversold level. But just because I'm kind of focused more on the tech names. But across a lot of these other names, like that have seen a lot of carnage, I guess. We did hit an oversold reading in that New York Stock Exchange McClellan, although not quite here in this NASDAQ McClellan oscillator. One of the things I wanted to highlight too for positives. Okay, we've got this. We've got the semiconductor industry, right? Some of these names did have really nice bounces on Monday, right? Despite the panic, they did have decent closing days. LRCX, NVIDIA, this is an important sector, right? So I wanted to highlight that. TSM undercut the 50, but has so far held the 50. That's very positive action. This KLAC and, Intel's back above all of its moving averages after undercutting. So, this is a really, really nice response for a number of these. ASML, right to that 10-day, 21-day. It deserves some respect, right? That move where it undercut the 50 and it did hold, right? It did have an opportunity to break and everything for, to sort of unwind, but these semis have proven to be a little bit resilient here. Now, Roy and I, we might talk about this more, but Still not great setups, right? You break the 50 and then you rally for 2 days, and you may be coming into these 10 and 21-day moving averages, or you may just be coming up the 50-day. Nvidia's continues to struggle below the 50-day now, and LRCX, also just rallying up to that 50. So yes, while they did have those really good reactions from the undercuts Monday, certainly not out of the woods, but it's just such a critical sector that we want to pay attention to. The other leading sector, I'll go through two more. Leading sectors also had really, really nice responses. SanDisk, which is a monster leader, didn't even hit the 50-day, rallied, is above the 10-day. All these Micron, Western Digital, STX, they're all they did all same kind of chart, right? They're the exact same chart. It's just you hit the 50, sort of undercut, you held the 50, you rallied, and you got this so far 2-day rally in those stocks. And then the optical names that we have been watching and traded a little bit here and there, but same thing, past leading sectors, really strong 2-day rallies. I will say they did fade a little bit into the close today, with the NASDAQ turning negative, I believe, by the close. So they did fade quite a bit, but nonetheless, they've given themselves an opportunity to build a little bit of sideways action and consolidate and perhaps be viable and continue leadership. It has to start somewhere, and if it's starting, and if they're going to continue to lead, that's exactly what what you do want to see is these breaks at the 21-day and immediately bounce back 20%, 25%. That's something to continue to keep an eye on. So with the negatives, I'll go back here before we start looking at that. The negatives, primarily what I was looking at in the first group, I would call them sort of secondary indicators, right? It's sentiment and breadth indicators that are, I don't think the thing to watch, right? If you could pick one thing, you would just look at the trend of the indexes, and that's kind of what the point of the negatives here is. All that is great. All that stuff is, the risk reward is improving. That is nice to see, but we're also seeing that the trend has turned negative, and it's kind of been curved. It's been confirmed by a number of the indexes now, right? At first, it was the Nasdaq. The Nasdaq was struggling. The Mag 7 were struggling. The software stocks were struggling, and then within the last week, we've seen the S&P break hard. We've seen the Russell and the mid caps, which were leading prior to this. So it seems like the negative trend is spreading a little bit. The Nasdaq here, while again, the character change happened here, right? This is where it all changed. We've seen this break of the 50 and immediately back above so many times. And then in February, we started living below the 50. So we've been below the 50 now for 6 weeks. I didn't include this on here, but what Roy and I have talked about for the long-term trend is 2 weeks closing below the 30-week moving average. We did that on, last Friday was the second week for the NASDAQ to close below the 30-week moving average. And that was from Stan Weinstein, right? His long-term trend template was based on that. So, that's a long-term trend change has just happened here in the NASDAQ. That's concerning. That's hard. And the market it appears that the market's going to be a little bit difficult with the Mag 7, weighing heavily on that stuff. They're such a big part of the market. It's just, they are hard. It is hard to, have a lot of positive traction when the big, the 7 biggest stocks in the world are struggling and they're chopping around. So, clearly like the 10 days below the 21-day, that's an important indicator for us. We're below the 50-day. All the index or all the moving averages are downward sloping. Now we're flirting with the 200-day, right? We snapped back off of it on Monday. Okay, great. That's great job. Great job, market. Again, showing that resilience that it is fighting it. But these things are rolling, and we're just getting, it looks like things are being distributed into these declining moving averages now, which is making the market very, very difficult, where you just don't want to chase up. And for us, we're going to look for a few things for the trend to change. One is going to be a follow through day. The other thing would be that 10-day above the 21-day. That would be helpful for us. And then we want the indexes above the 50-day. So, those are probably three important trend change signals that we're going to be looking for that are going to force us in, back into the market to some extent, if and when those things do happen. Of course, they will happen eventually, right? It's a matter of when, but for now, that's the key thing here. The sentiment's improving or whatever. The risk reward is maybe changing based on some sentiment indicators. The trend is negative. It's decisively negative for the NASDAQ now too, on all time frames. The S&P 500, again, that was the leading index. It was holding up much better. Right here was, I think, the Wednesday before NVIDIA above the 50. The choppiness being very difficult, and then more recently rolling in the last 8 days. The 50-day is turning down. The 10-day is decisively below the 21-day here. All the moving averages are moving downward now, where it looks like it looks like rallies could and maybe should be sold into. So the S&P, certainly changing here. Again, we were breaking the 50 and snapping back, or holding the 50 and snapping back over and over and over again. And now we're starting to maybe live below it. So that's a character change for us. Again, the Russell here. This was, the Russell before we invaded Iran, I think, was right here. Holding up really, really nicely. Gosh, just $5 off the high. And then all of a sudden things have changed. The 10 days below the 21-day. The 21-day is coming below the 50-day. We're below the 50-day right here. You can see where we rallied to the 10-day today, and then met some resistance. So certainly seeing a change there. Same with the mid cap. I think that was, again, the day before we invaded. That was a Friday. Looks poised, looks strong. And then, hit with that change where we broke the 21-day, and then same thing, 10 days below the 21-day. Now the indexes are below the 50-day, hit some resistance into that 50-day right there. And definitely a change in character with the volatility and trend changing there. One of the leading sectors too. I'll go through a few more leading, sectors that were holding up really well until the last 6 days, which begs the question, right? Like if the war ends, or if oil comes decisively lower and breaks trend to the downside, do these stocks bounce back and lead again? Maybe, right? But who knows? To guess that. The transports, this sector is one we were looking at. They all were holding up, right? Oil was rallying for 5 days ahead of the invasion, and it didn't seem to bother any of them. But then, Monday comes and you have a 25% move to the upside, and all of a sudden that risk, culminates in this break in the transports. So really, really, really nasty action there across the trucks and trains. Financials. This is something too. Again, we were trying to be objective and say, okay, do we need the financials? And a lot of people would say, yeah, you do need the financials. But if stocks were going to, rallying without them, okay, who am I to judge? If the transports were up here and financials are down here, I'm just going to buy the transports. I'm not going to sit here and say, well, there's going to be a credit event and get all bared up. I'm just going to look at the chart that's in front of me, which was, the transports, as an example right here, right? I mean, why would, if that's all you had to look at, you'd say, okay, that's buyable. Forget that other sector. But the fact is, the financials are weakening. Never a good sign, right? I know you do want these to participate in the bull market, absolutely. And they're continuing to struggle. They are, the 50-day is declining now. They haven't had a whole lot of great rallies here. You see them hit the 200-day a couple of times right here, and that's acted as some pretty stiff resistance. And you can see, wow, all these red bars, right? This is, this is quite telling. The amount of distribution that you're seeing in the financials is I don't know, I guess concerning. Here's regional banks. Again, everything looked hunky dory. just 4 weeks ago. The KRE, the regional banks were making new highs, and then something changed here. This day in particular was a big character change, breaking the 50 decisively on volume. The 10-day crossing below the 21-day. That's a sell signal for us right there. And that's what hit the Russell, right? The Russell small caps were they're a large part of that index. So clearly that's what happened here. And with that, the trend has changed, and it's telling us avoid, and we don't know how long that is. The VIX, I put it in here as a negative when, in reality, you can look back. I sort of didn't know if it should be a negative or a positive. It hit 35, which is it's a massive spike. We know we can spike higher, right? We know we can do that. And that's what we needed. And, we needed higher spikes in that August pullback of 2024, and then the bear market in March of 2025. So, arguably, did we spike? Is that it? I'm not sure. If we're going to live up here a little bit longer, this is what Keith calls the chop bucket. Anything north of 20, 20 to 30 is the chop bucket. What we know is, okay, we closed at 25, firmly right in the middle of the chop bucket. That's a tough position trading market. That's where you have to be quick on the trigger. You have to buy weakness, and you have to sell strength in 1 day, 2 day bounces. That's where we are right now. We're in the chop bucket. And so I didn't know it. Maybe, are we having this trending volatility breakout? Are we going to continue to rise? Or was that the spike that we needed to put in a low? That's obviously the question. We obviously don't know at the moment. So this is either, again, it's a little bit ambiguous, this particular data point, but important to understand, where we are, and know that when the VIX is 20 to 30, it is just going to be harder. You're going to want to tread lightly. When we're down here below 20, I mean, that's when, June, July, August, September, those were good months. We had these periodic pops to the VIX where we hit 20 and then quickly fell down below it. We can see the volatility of the volatility here, extremely choppy, and continuing to kind of be in this upward trend in volatility right now. And then, last thing I guess I'll go over with charts is breadth. This is really similar to the sentiment thing, where the point is it's pretty neutral. We're sitting here at 39 stocks above the 20-day moving average for the NASDAQ. It's certainly not overbought, but we know we can get more oversold. And, the point is, if this is an indicator that we're going to continue to watch for a short-term low, we want to see something closer to 20. And, look, you have good lows when you undercut 20. So less than 20% of stocks are below, or sorry, when less than 20% of stocks are above their 20-day moving averages, that's a really good washout level. So my point is, if we're going to get washed out, let's just say the indexes can't hold, keep an eye on that. And if we hit something like 15, there's a good chance that we've got a real tradable rally in place. And that's going to coincide with those sentiment things spiking that we talked about as well. Probably putting in a good low. None of this has to happen, right? But just this is something that we want to pay attention to, because we've seen that happen, over and over again. Even right here, right when you thought maybe the low was in the 2025 bear market, you did have that number come down to 20% right here, and you kind of, at least you were able to get a little bit of traction before you were, ultimately rug pulled with, increasing trade tensions or whatever he was doing there. So yeah, this is an indicator that we're paying attention to. This is like the same idea. It's the stocks above their 50-day moving average in the NASDAQ. Same thing, look for a low here. I don't know, 10, 15%. You can see where it hit, comes into 20%, several times in the past. So another indicator that just moves a little bit slower. And then here's the stocks above their 200-day moving averages in the NASDAQ, hit here at 37.5. The April low back in 2025, close to like 12%, I think is what it was. So, there's room to go here. The 2022 bear market, I think that was under 10%, but that's a very prolonged bear market. Sure, we don't know if that's going to happen. Any kind of prolonged bear market, we have no idea if and when those things are going to happen. But nonetheless, I think it's something you guys should monitor on your own as well. It's a helpful tool. Okay, and then negatives. Here's the last thing I'll talk about. Negative narratives, I guess. One is these hyperscalers. I think we were talking about Oracle after hours today, so they're up like 10% or something after hours, maybe. I haven't checked in hour and a half, but they had their call, okay, and they're extremely beaten down, and everyone's been skeptical of their of their revenue growth and their remaining performance obligations, right? Because they're extremely levered to OpenAI, and OpenAI has to raise capital, and they're making they've got a $10 billion annual run rate of revenue, and they're committing to $500 billion in investments, right? So everyone's kind of skeptical, and they're raising debt, and they've got to fund all these huge data centers. And I was just, Roy and I, we were talking about this. I was showing him some of the financials. So I was like, okay, I get the narrative. They're going to have to invest. NVIDIA is so important. They're going to, the hyperscalers are going to keep investing, and they're going to invest even more in 2027 and more in 2028. Just looked at the numbers and how you get there, and it does get a little bit difficult for the hyperscalers to continue to grow CapEx. And so, you wonder why NVIDIA is not going anywhere. Well, I guess it's because this very well could be as much as they can do. A lot of, Amazon and Google, Meta and Microsoft, when I was looking at their free cash flow, it does require them to actually grow. So they, in order for them to continue to grow their CapEx investments, they do have to generate revenue very quickly from their CapEx investments to be able to then, turn it right back in to, the next generation of NVIDIA GPUs. And, maybe they can do that, maybe they can't, but it's definitely not like a foregone conclusion. And, it does explain a lot when, their earnings are going to be growing, their adjusted earnings are going to be growing the next couple of years. But then you look at the CapEx and you see the free cash flow hit that they're going to be taking this year and maybe next year and, the following year. So anyways, it's just that's obviously in the back of our head constantly. And, it's just something to be aware of. I'm open to anything, right? It's no revelation that the mags are struggling, right? The mags are in a downtrend, and we're in a downtrend before the NASDAQ and the S&P and the Russell and the mid caps were. But important to know and understand the context, right? And I was just asking that question, like, well, is that even reasonable? Can they? How is this not peak earnings? And it is kind of hard to understand how it might not be, how this is not peak CapEx, which then weighs on the entire semi cycle. So anyways, important to know. I'm not going to get stuck to a narrative because I don't know, and then I'm just going to trade the trend. That's what we know we have to do. The other thing to talk about, right, since this is a real big driver of the market right now, it's the war, and basically it seems to be what's happening to oil prices, because the strait is closing, or they're putting mines in the strait so that ships can't go through, or we're getting escorts from battleships or whatever, to destroyers, to get them through the strait. I don't know, but I was just going to suggest this because I don't, there's a lot of noise, but this is a nice resource that now exists. It's Polymarket. All these betting markets can maybe give you a better idea of what's really happening. It'll give you an idea of how long the markets here expect this thing to last, right? Because obviously you might see Trump say, look, we're gonna, our objective's gonna be done in 2 weeks, and then we're gonna get out of there, and we're gonna have a new regime in place. And then you can go here in Polymarket and say, what are the chances that there's a new regime in place by June 30th of 2026, right? So in the next 4 months, and it might say there's a 10% chance. Well, we're hearing one thing out of his mouth, but the markets are saying something. So the market, obviously trust the markets first. So that's what we all love the markets, and because it's a source of truth, really. And this is, this is a new product that I think is really cool, to be able to look at this stuff. So if you're confused, which I'm sure we all are, extremely confused by the market action and by oil prices and by what's happening in Iran, we have no idea really. I'd suggest going here and trying to get as close to the truth as I think we possibly can. So right here you can see a very simple link there, polymarket.com/Iran. Simple as that. So because I don't know if this is exactly the same type of, it shouldn't be the same exact thing as tariffs, right? Like, I know Trump wants to think he can tweet his way out of it like he did in the tariff situation. But there's a lot of different actors, and there's a little bit of inertia, I think, and momentum in place here. He started a war. Israel is they have their own agenda. Iran may not, they're not just gonna flop. There's a lot more at play here versus Trump's executive power to reduce tariffs or increase tariffs. So while it seems to be that he's staring at markets and trying to calm the markets all the time because of this invasion or this attack, there's more to it. So this is the way to maybe sift through a lot of the complications of what war brings. So should be helpful. That's what I'm going to be looking at. I'm going to have that up, on my screens every day, just to see real time changes and the situation for Iran versus watching CNBC or having some tweets out there that are then being backtracked. So that's really all I've got now. I hope that was helpful. I know there's really no conclusion, because we're in this. I think we're in a period that's very uncertain. The trend is negative. Some things are improving on a sentiment basis, but that's kind of what I'm looking at right now. And Roy's going to, hope he's going to go over some of the stocks. We've got a little bit of a buy list, but it's I think he'll show you that it's definitely tricky to get involved in these stocks. Buying breakouts hasn't been working for months. Buying undercuts and rallies has worked. Buying stocks at moving average support has been better risk reward. Maybe shorting into declining moving averages is also in play. But definitely, it's shorting when the market's gapping lower or buying when the market's gapping higher has been a fool's errand for some time. So keep it small. I'm sure that's kind of an important theme. But with that, I'll hand it over to Roy, and Roy, you can go over some of these some of the stocks that we've got our eye on.
That sounds great. Thank you, Wes. Wes, go ahead and pull up Market Surge, and let's take a look at our buy list. This is an updated list for us that we think is very timely in terms of where the action is right now currently. And we think it's important to keep this watch list, buy list, whatever you want to call it, handy, so that you know that if we get a follow through day or if the trend changes, you'll have things to buy off of this list. So that's how we're approaching things.
Yes, here we go. All right. Oh, just kidding. Here it is.
And go ahead and expand the buy list, the push per cap watch list there, Wes. Buy list. Okay, you guys can take a screenshot of this. This is in alphabetical order. And
Hmm.
this is what we view as the potential leaders in the market right now. So, uh, our buying, if we were forced into buying on Thursday, which is the first day that a potential follow through day would be activated, most assuredly, they're going to be off of this list right here. And normally, when you have a choppy market like this, and we've been consolidating, and when the bias is negative, you do need a follow through day, and a follow through day is typically day 4 to day 7, day 4 or later, after the market makes an important bottom and a reversal. We had an upside reversal in the market on I guess that
Monday.
was Friday, right?
It's just Monday. Yeah, Monday is when we got
Okay,
down. Yeah.
actually, yeah, it was Monday. So this is day 2 of an attempted rally. So using O'Neill's methodology, if we get a follow through day, the earliest that would happen would be Thursday. And we've seen that most of the good follow through days happen between day 4 and day 7. So the window, if it's going to work using this a narrative as initiated and activated a new uptrend, the earliest is Thursday all the way to Monday would be the best time for that to happen, which certainly makes sense because of from a timing perspective. Now we are getting some economic news out. We're getting the CPI and the PPI out in the next day or two, followed by the PCE inflation news on Friday. So that's going to be monitored closely by the market as well. But it is a late indicator. It's not going to reflect what's going on in the energy market, which you'll see. You'll see the next month probably be impacted. Inflation will be impacted, by energy prices. So, this particular economic news is probably not going to have much of an effect. It's going to be more. The markets can be more driven by Trump, his tweets, and oil prices primarily. So, Wes, did you expand that buy list and go all the way down so people
I
could
did.
screenshot?
I did
Okay.
scroll down. I didn't indicate for anyone to continue, but yeah, here's the bottom half again with that
Okay.
list.
Okay. And we do think this is a very, very interesting list, and this is where we think the leadership remains today, and we'll see if it will continue or not. Clearly, the leading industry groups have been the memory stocks, SanDisk, Western Digital, STX, and MU, along with the optical stocks, AAOI, LITE, and Sienna, Corning, etc. So that's where the quote hot money is participating right now. It's going to be very, very interesting to see, however, if the market and if these stocks go sideways, or if they have a 2-day bounce and they resume their downtrends over the next couple of days. They're not, they're really not buyable. If you take a look at the chart patterns, they're not buyable. But if they could go sideways for a day or two and then take out, the most recent pivot, that might provide an excellent opportunity to add them back to the portfolio. And that's what we're considering and looking to do. But the setups have to really be pristine, because right now you can't argue with the trend. The trend is clearly down in the averages and in the indexes. And what we found over the years, over the decades, in fact, is that it's very, very difficult to have individual stocks, even true market leaders, go up when the averages are in a distribution phase. And they're clearly in a distribution phase right now, as we have 8 or 9 distribution days on the NASDAQ. And I'm not sure how many on the S&P, probably 4, 5, or 6 or so, but we were up to 9 or 10 distribution days on the NASDAQ even a couple of days ago. And rarely can the market make headway when you have underlying distribution or selling by the institutions, while the institutions are selling while the market continues to stall and go sideways. So that's something to watch closely.
By the way, it's 8 on the NASDAQ and 9 on the S&P right now.
Okay, and this remains to be one of the highest levels that we've seen that I can remember, over in years, 5 or 10 years. So we're clearly in a very important time, and it pays in our view to be more safe than sorry. So we're 100% cash. We're in T-bills right now, and if we and when we come off the sidelines, which obviously we will, we'll probably take probing positions of probably 2.5% to start, no more than 5%, and until we get great feedback to see if we can get traction or not before we employ or allocate more capital. So it's definitely not a time to plunge into the market. It's definitely a time to strategize and just evaluate it and observe it. This is a great time to observe with really what's happening, and it's very difficult to observe what's happening if you're under pressure, in your portfolio. So we prefer to step to the sidelines and observe, take a fresh look, reset, and be ready for the next uptrend, so that you can take fully advantage of that uptrend when it occurs. Wes, do you have anything to offer, to add?
Well, no, I mean, I don't, other than, there's a couple of these questions that we can also touch on, unless you just want to wait. And do you want to look at any stocks, or do you want to just go with the questions?
Let's just have the questions, and we'll see if people have any questions on individual stocks.
Yeah. I might as well just go, do you want to buy anything going into the weekend? News drops about an hour after the market close. Gosh, no. But that's kind of been a theme. I don't know. No, that's the whole idea. And the whole problem is you see this and you can hold stuff, and then maybe you've got all this anxiety, and Sunday, with no liquidity, futures are down 2%. And then you're nervous all weekend, and then you bottom on the open and everything goes green. And we've seen that for 2 months, a lot of that kind of action. And we keep thinking, we're like, man, it probably, could be a nasty Friday, right? Could be a nasty Friday. No one wants to hold into the weekend, but then Fridays are fine. Too. That's a personal preference, but yeah, right now, no, of course not. That's how I feel. But go ahead.
It's important to determine if the setup is there. If the setup is there, it should not matter what day it is. Friday, Monday, Tuesday, Wednesday. It shouldn't matter. But the question should be, well, is it an authentic, low risk setup? And we haven't had any of those, for months now. The setups, when they've taken place, they've immediately failed over, after just a couple of days. Even if you bought yesterday at the open or pre-market, yesterday when the market was plunging, based at looking at the individual charts, they're not really great setups to buy right now. Wes, go ahead and pull up Light. So let's take a look at Light and AAOI. Mm-hmm. And these are perhaps the two leading stocks, in the market today. And you can see LIT had this major correction, over the last week from 700 and like $80, $737 or something like that, all the
83,
way
yeah,
to, to
783.
under, okay, to 500 and a change. And you've got a 2-day bounce. You can see where it closed at the low of the day, and that is not a legitimate setup. Now the stock, you can see the stock is showing up 14 bucks pre-market or after market because of presumably the Oracle news. But just because the stock is gapping up doesn't mean that it will hold, and so that's not a legitimate base in that particular stock. So if the stock, what you would like to see, and it's certainly the leading stock in the market along with AAOI, what you would like to see is that you'd like to see the stock go sideways for a few days and then take out today's high, somewhere, in the next 4 to 5, 4 or 5, 6 days. And that's what you would like to see. But, the stock has been in a nice uptrend, and, you can see the uncharacteristically poor behavior after the stock peak. So you got to be careful that you're not buying the stock once when the stock has made its all-time peak. So you got to be very, very careful in something like this. Go ahead and pull up AAOI, Wes. Again, another leader. You can see that it closed middle range. So presumably, and this stock has gone vertical, and that's a parabolic move as well. Presumably, you've got to be careful that this isn't, a top's not in place, and both of these last two stocks may present a better shorting opportunity tomorrow than a long opportunity, where just a pullback from today's high all the way to the 10-day would yield how much is that, West, to the 10-day?
Yeah, this is 28%. I mean, yeah, that's correct.
Yeah,
That's
28%.
way too much risk for an entry right there, right? 28%, and then 136% to the 50-day. I mean, that's it's massive, right? That's a massive risk.
Yeah, so that's both of these. As you look at if you look at like blow off tops like silver, for example, you can see how extended these stocks can get, and you can see the downside as well. You can see the blow off on silver there. To that was $109 all the way back down to 65.
Yeah.
And in just days, essentially. So that's what you got to be careful of, that once these stocks go parabolic and everybody's sucked in, they make meaningful tops, and then you can just get eviscerated in them if you're on the wrong side. So you got to be careful from that with that buy list that I just showed you, because frankly, we don't know where these stocks will eventually go. We know that the fundamentals are top shelf, but of course, we also know that stocks peak when the fundamentals are best.
Right. Yeah, there's a very good chance that AAOI is spiking and peaking, and just like silver, right? And then you just don't want to sit there and try to get back into it. Oh, I missed it. And try to get into it, because now silver, if you've been trying to trade it, it's been a mess, right? The peak's in, it becomes a mess. So maybe not, hope maybe AAOI can consolidate really, really nicely and not plunge. But yeah, the risk is pretty high on that one, I guess, today where it closed. But also I wanted to say one more thing on this question. Would you want to buy going into the weekend? I'm not going to want to. And this always happens. This happens when Roy and I are like on the sidelines and need to get invested. I never want to invest on a follow through day. It never feels good, right? For one, first of all, it's, the market's up like 1% and we're like, okay, do we have to buy? and it feels like you're chasing, right? But then you have to get involved. You have to have something that gets you off the sideline. And if you're sitting there saying, I'm not buying anything on Friday, well, you might end up, there's a good chance that something's leaked and the market is, anticipating a deal in Iran or something, and the market's up 1.5% and oil's coming in, hard, and, it's 3 o'clock and you don't own anything and you're saying, well, I'm not going to hold into the weekend. But, there's a good chance the market forces you to do those things you don't want to do. It's going to make you be uncomfortable. So, just keep that in mind too, right? If the setup there, if things are, if for whatever reason it's a Friday follow through day, and there are 10 things on our buy list, and all of them look spectacular, we're gonna have to buy them despite what we want to do. We're just gonna have to, because we know better than to just not to sit there and stay flat footed. So it would not be shocking, right? That's what happens. That all these stocks are breaking out everywhere. It's Friday, and then at 4:30, Trump says there's a ceasefire and we're putting in a new, president or whatever. They're going to have democracy and yada yada. So just yeah. Anyways, despite what you want to do, that's an important thing. Just you're going to have to force yourself, despite what day of the week it is, and all that. And the way you can also combat that is, like, you don't have to go 100% long, right? Don't go from 0 to 100. You don't want to sit there and think about it for all day Saturday and Sunday. Like, oh man, what have I done? I just went from, I'm 100% invested. So yeah, it's incremental, but also just, following a process that forces you back in, will help you, get rid of some of those opinions that could get in your way.
Another word to the wise as well is stay away from margin, and also stay away from the leveraged stock derivatives. So many of these stocks now, and ETFs as well, they've got double leverage. Be very, very careful, particularly on the stock side, with being long, some of these ETFs, and they go against you because, again, you saw the move here in silver where it dropped 60, about 50, about 40%. So you essentially could be almost, if you bought it at the high, you could have blown yourself up. And many of these have that same characteristic, that it can happen with any of these optical stocks as well. Wes, let's take a look at a couple of these. Pull up SanDisk. We'll look at SanDisk and Corning and MU. And again, you see this nice uptrend, and that might be the last hurrah of SanDisk as well. We'll find out, in upcoming days. But you can see you got the 2-day rally, and then of course with Oracle's news, we're going to have in these opticals and memory stocks, we're going to have, we're going to have a gap up on all of these tomorrow. But I think it would be, I think it's going to be very, very dangerous if you buy the gap up, tomorrow in them. Of course, we're not providing any investment advice, on this channel tonight, but I would be more inclined to short the gap ups tomorrow. And many times these leading stocks peak in the first hour of trading. So, we would look for a gap up tomorrow, followed by a reversal later on in the day. But we'll see how it unfolds tomorrow. Pull up MU, Wes. Another memory stock, and we know that we know that the suppliers for the data centers and so forth, there's a memory shortage going on, and that's fueling the drive here in these particular companies. Now, what's difficult is that Micron reports in 8 days, so you've got only a few days. If you initiate a new position here, you only have only a few days to build a cushion up to hold it into earnings. And that might be problematic. So just because of that, it's getting so close to earnings. That would be very difficult to buy as well because of the earnings risk.
Yeah, St. Corny too. Good. Yeah. Let's see. I mean, housing. I mean, I honestly don't know. Well, I think it got hammered, and I mean, that's the story of a lot of these market. A lot of the market, completely broken chart now. It certainly looks like it was ready to go. It's perked up several times and everything, but a lot of these are early cyclicals, and you would have thought with the action that they could have been an important sector for us, but they just broke. So I don't know. I don't have an opinion. It just looks ugly.
Yeah, it's been a difficult trade because, and again, you've got to look at where yields are and what the bond market is demonstrating, and which in itself is difficult to ascertain what's going on behind the scenes, because you would think with with the flight you would think that with war upon us that interest rates would be going down, while in fact interest rates have risen, and that's very counterintuitive to what you would really expect. It's much like when Russia invaded Ukraine, I think 4 years ago, and you would have thought that their food supplies and so forth were going to and wheat and corn and all that, they were going to collapse, and in fact they did not. They did not do so. So you would expect, in war, you would expect, bonds to go lower, bonds to go higher in price, lower in yield because of the flight to quality, and that hasn't happened. And of course, because housing stocks are interest rate sensitive, that's why that's clearly why you see the sell-off there. We have tried this, and we owned a housing stock and got kicked out of it, a few days ago, and that was Toll Brothers. And so we also had one position there that we got kicked out of as well. But at some point, you would think the lower interest rates and the lower interest rates would occur as AI drives interest rates lower, and but this is one that recently broke out, and we were participating. We got kicked out of it 4 or 5 days ago as well.
Yeah, I mean, we don't own anything. So that's kind of a couple of questions. I don't know what this means. Day two. Oh, day two counter. Yeah, that's what I'd say,
Yes.
right? Day two for the follow through day. So day 4, Thursday, what we're considering.
Now, we've done quite a bit of work on follow through days and studied them extensively. So we can't find an instance where a new market uptrend has not had a follow through day at some point, in time. But if you don't get a follow through day in the window, and normally, again, the best time for those follow through days happen day 4 to day 7. The best follow through days occur then. But half the follow through days fail. But if you don't get a follow through day, over a 20 to 30 day period of time, and you haven't had one, what forces you in would be a trend change where the 10-day crosses the 21-day. That's the first thing that you would look for in the indexes. And that's where, if you happen to be out of the market, that would be our modus operandi in terms of what gets you back in the market if you're 100% in T-bills. We're looking at for a follow through day first, and then we've talked before about incrementally, adding exposure, and we've if you check my Twitter feed, we described that in specific detail from the April bottom in 2025, how we incrementally added exposure as we started checking boxes as the market started going higher. So you got to have some type of process. The follow-through day would be the first thing you would want to see. The second would be the 10-day crossing the 21-day, 21-day crossing the 50, and getting above the 21-day for three consecutive days. You'd like to see the averages get higher. The low of the 20 of the averages get higher than the 21-day. You'd like to see that happen as well, over time. But many of these things don't happen exactly at the same time. They happen at different periods of time. But again, price is the most important ingredient to watch. But the action of the individual stocks and the action of the market will dictate how to add exposure appropriately.
Yeah, that's it. I mean, I know this is potentially just an abbreviated stock selection. We have our list there. But yeah, there are no more questions, and we're just we're certainly just we're waiting and watching in the meantime. Roy, you have anything else you want to touch on?
I don't have anything, Wes, other than for the viewers, go through, take a look at all the stocks that we have in those. The leading stocks are going to be on that list right there, and I think we've got 75 names on the list right now. So we're going to be spending our time over the next few days diligently looking at those stocks and looking at buy points. For us, what we would want to see is, because of the distribution, we would like to see these optical stocks peak tomorrow, have key reversals where we even would consider shorting them, and then waiting for the next, waiting for an appropriate follow-through day before we really get involved in the market. Back in 2022, we stayed in cash for 9 months, and you never know what this market will morph into, and it's important to just be, as Wes said earlier, be balanced in your approach, and at least have a process that makes you initiate positions accordingly. And again, our process has gotten us out of the market, and now we're just content to see and observe what happens. But we could clearly reverse our position within a couple of days if the market tells us to do that. If we do that, we will be posting our views on Twitter along with the stocks that we're probably taking positions in. So be sure and follow us on Twitter. Pay careful attention to that. This is definitely the time to stay in front of your machine and be aware and ready to take advantage of the next uptrend.
And Roy, I just I didn't touch on this earlier. Last little housekeeping thing I wanted to just touch on. If you happen to be a client of ours, at Integrated Financial Strategies, you most likely you'll receive an email from us in the next day or two. We're basically becoming a part of a larger firm. There's going to be a merger. Our partner is merging and with another firm. It's called Prosperity Wealth right now. So just a heads up. That's nothing changes. There are no account numbers change. At Schwab, simply the name of the firm is really going to change on statements. Literally, nothing that anyone needs to do, but you will receive an email about that. That's just wanted to, in case you are on here and you see that email, do not be alarmed. Nothing for you to do, but just a heads up that because of the firm we're in and the partner of ours that's going through with this merger, we will be going by a different name as a firm. So that's it. Just wanted to, so nobody's caught completely off guard. That is, that's in our future.
Thank you, Wes. And viewers, thank you for listening and watching tonight. Again, we thank you for following us on Twitter, and we hope that you'll have a very successful trading success in the upcoming days. So have a good night, and we'll see you next month.